you telling me that you have a way to defer the tax situation there? Is that what you're telling me?
Yes, absolutely. Yes. So the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust.
A real eye opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The Deferred Sales Trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
Hello, everybody. Welcome to another Capital Gains Tax Solutions Mastermind Masterclass on the Deferred Sales Trust and finding ways to create and preserve more wealth using advanced tax strategies. I'm excited to be here on another Friday with all of you joining on either YouTube or Facebook or watching us on a replay here. If you're not watching us live, we believe that most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options, and not having a clear plan is the enemy. And using a proven tax deferral strategy, such as a deferred sales trust or a 1031 exchange, sometimes it's cost seg, sometimes it's a donor advised fund, sometimes it can be a number of different things. But in particular, we focus like a laser on the DST as a way for you to preserve your wealth when you exit, to defer somewhere between 25 and 50% of the capital gains tax and depreciation recapture, and then be able to create wealth as you invest it at optimal timing. And that could be back into your own deals. It could be in deals with other people. It could be into stocks, bonds, and mutual funds. It could be into T-bills right now, which are paying like 4 to 5%, pretty risk-free at this point for T-bills. But the key is unlocking freedoms for you as the client, and or if you are a business professional watching this, for your clients, so you can actually grow your business, get that new luxury primary home listing, get that commercial real estate property, get that M&A or business sale for your clients by solving what we think is the biggest expense that you're likely to have on your $1 million exits, which is capital gains tax and depreciation recapture. That being said, I am joined by some amazing individuals that are part of our strategic alliances. And we do have the Jake Miller, who's probably one of the top financial advisors that I know for sure. And he's entrepreneurial. He's great. Jake, how are you doing today? You're on mute, but as soon as he unmutes himself, we can probably hear him.
We got some very loud tropical birds here in the background, so I apologize if you don't hear everything that I say. But how's my sound coming in, Brett?
You sound really good, Jake, and looking good. Looks like you got some tropical stuff. So where are your adventures taking you today?
Today, I'm in the city of Cartagena. They had an expo here, and tragically enough, I had to come out to this oceanside city and participate.
Excellent. Fantastic. And we also have the Brent Silverbauer, which, by the way, he's kind of a new addition to the Capital Gains Tax Solutions Mastermind. He is a Northern California EXP multifamily agent, and he's amazing. He's a digital marketing expert. Brent, how are we doing today? If he can hear us, if he's still here. Maybe he jumped off. We do have the Pierce York. Pierce, how are we doing today? Man, I'll just keep going. Unless they're on mute, we can't hear you. But so let me tell you a little bit about what we're going to do today. We're going to talk about kind of the topic of today. And the topic of today is really the amazing ability to compound interest in a tax flow efficient way. Jake Miller, would you define for us maybe the law or the idea of compounding interest, and why many believe it to be is it the eighth wonder of the world?
Well, Brett, here's the magical thing. A lot of us know and understand simple interest, which is, hey, if I get 5% every year, that's 5% on my principal balance, let's say $100,000 every single year, where, hey, year one, and I now have a new balance of 105. Year two, I now have a new balance of 110. Year three, 115. It's just simple interest on the principal. Compound interest is interest on interest. So not only am I doing 5% on the 100,000, but I'm doing 5% on year two of 105 from year one. And then I'm doing, let's say that's now 106.5. Instead of 105, 106.5, and then 111, 10. Anyway, you can see that the numbers just climb higher and higher in exponential growth, where interest upon interest sometimes provides your biggest gains. And that's the magic or the eighth wonder of the world is compound interest.
Amazing. And we're actually going to show this here, what this looks like, and introduce a new concept with the ability to double your money in a quick way. And it's simple math, by the way. If you can earn 7% compounding, what happens is within 10 years, you let all of that interest just build on top of itself. Like Jake was saying, the interest builds on top of the interest. You're going to double that money. So let's say you put $1 million into an investment that's producing 7% per year. Well, guess what happens? Every single time that year goes by, another 7% is there, and it just keeps going down. Now, within 10 years, at year 10 exactly, actually, that $1 million will become $2 million. So let's talk about this idea as far as pertains to doubling money using a penny. So if you take one penny, Jake Miller, and let's say you had one penny on day one, and it doubled every day for 30 days, how many dollars would you have?
I definitely love to have that scenario, Brett. I'll tell you what.
Right, and there's a whole. If you ever heard this question, you tell kids, "Hey, if I can give you $1 million today, or I'll give you a penny every day, and we'll double the amount every day that I give that to you for 30 days." And at first thought, you might think it's the million, but it's actually not. It's the power of compounding interest at work here. And on the first day, you have a penny. On the second day, you have 2 pennies. On the next day, you have 2 times 2, and so on. It just keeps going. Essentially, and these numbers are about 5,368,709 at the end of 30 days. And that's the power of compound interest. And it's equivalent to 100% interest per day paid daily. On even a penny, your initial investment, it climbs immediately to unfathomable heights. Okay. It's the eighth wonder of the world, power of compounding interest. Now, here is the question to this. You've probably heard this before. Jake Miller, I wonder if you can take a stab at this. We're talking about tax flow, compound interest with the DST, because guess what? Not just about cash flow, it's about tax flow. And if we can take the eighth wonder of the world and apply that to what we would have paid of tax, somewhere between 25 and 50% of our gain on our exit. Jake, I'm curious, what do you think? Let's just use 28% as the number. Let's imagine someone were to have every single day, instead of having that full penny, Jake, they have 28% of that taken out. Okay. Instead of that full penny, they got to put the full penny in, but then it gets taxed at 28%. So now they have 72 cents So you have 72 cents instead of $1, right? And then on day 2, the same thing happens. But basically every single time they're getting about 28 cents taken out, or 28% is actually the number. Okay. Jake, I'm curious, at the end of 30 days, and everyone can participate as well, you can put it in the chat what you think the number would be. In fact, I want to encourage everyone to put that number in the chat. End of 30 days, before Jake gives his answer, his eloquent answer here, please put in the chat, at the end of 30 days, how much do you think, if 28% was being taken out every time you went to put that penny or that amount in, instead of $5.368 million, what would the number be? What would I have? We got 9 participants, so I'm gonna look for 9 chats here. Just go ahead and put that in there.
So Brett, the performance of doubling your money every day on a penny, with or without taxes, is the question.
Correct.
So should we have to pay taxes, or should we not? If we don't, we get 5.8 million.
Correct.
Should we have to pay taxes throughout? And instead of having a full penny, we only have 72 cents. And trying to double that versus doubling the entire penny, we're going to be incredibly crippled, and not just by 28%. This is going to probably cut our 5.8.
Okay, so Jake's guess is 1/2. Is that your final answer?
My final answer.
Okay. Pierce York, what is your final answer?
I think it cuts it by like 70 something percent. If you're taking it out every single time, right? Because you don't have 72 cents,
Yeah.
you have 0.72 of a cent.
Correct.
So 0.72, and then you double it, but then you got to take 28% out every time you're doubling it, right?
Yeah, essentially.
Or
Yep,
is
exactly.
it just the 5.5 is minus 28%?
No, you're right. Every single time it's being taken out. So like every time instead of putting the $1 in, you're getting taxed 28%. Instead of putting the next amount in, you're getting taxed 28%.
Yeah, so I mean, you gotta just multiply by 0.72 every single time you double. So you're probably going to take out. You'll end up with less than $2 million. I bet.
Okay, so is that your final answer?
Yeah.
Okay, so we got basically $2 million, 1.9. We got 2.6 for Jake. Anyone else? Anyone else? You can put it in the chat. You can also unmute yourself and just tell us what you think.
Might be like 900 grand.
Give everyone about 5 more seconds. Okay, are we ready? Drum roll, please. Oh my goodness.
Yeah, that's crazy.
Less than $70,000, ladies and gentlemen, at 28% tax. Now, when I first saw this at the DLP conference last week in New Orleans, first of all, my jaw dropped. Second of all, I said
over how many periods was this, Brett?
30 days. 30 days.
Okay. Yeah.
Okay. And I'm still wrapping my mind around this, by the way, everybody. Okay. And I'm getting the slides so that I can share these slides next week with everyone. So that's a chance for you guys to come back. I'm going to share the entire or a big portion of the presentation because it was so rich from a guy who's I think probably worth about $1 billion and did the math in detail. And so, but just think about that. If that is true, and I believe it is, in fact, he said it was like 67,000 and change, something like that. Okay. If that's true, this is just mind-boggling to think about. 28%, and it shows the law of compounding interest is kind of reversing it, what it would be versus the $5.6 million. So
See, that's right. Absolutely. Over 30 days or 30 periods, the difference is phenomenal because that's compound interest. When you have the time is where you make the biggest amount of your money.
Yep. And it's towards the tail end, right? In the beginning. So when you pay a home mortgage, by the way, like a lot of it's just heavy interest up front. You're really not paying principal to the later ends. And so this is all happens kind of at the end. But if you're getting every single time at 28%, right? It's very tax inefficient, which kind of reverses it to not be very, very substantially less, 5.6 million versus about $70,000. Okay. So that's why we're here. Essentially that we want to help you not only defer capital gains tax on the exit, but then invest it into things that hopefully over time we can use the law of compounding interest. But by the way, can you take interest payments from the trust, Jake?
Absolutely.
Can you take partial interest from the trust, Pierce?
Yes.
Can you take full interest in principal payments from the trust, a portion of both?
Yes.
Yeah, so it's your money, but can you also, Jake, take no interest payments for a period of time?
For a short period of time.
Yeah, right. And that's the neat part about the deferred sales trust. It's flexible in that you can let the law of compounding interest build up or take partial interest payment and let the other amount build up. And this becomes a building wealth machine versus just a tax efficient machine. Now, how do we build wealth with this, Jake? I think there's a couple things we do, right? Can you talk about optimal timing and the ability to diversify?
So optimal timing. In the last session, Brett, we discussed very heavily a 1031 comparison with a DST. And the biggest impact that it had on people is that you don't have to buy high and then sell high. You can actually buy low and sell high. With the DST, timing is in your court. You don't have to be in one market. Let's say that you're in Texas, or let's say that you're in Alabama, and in the same market, find a like-kind property to roll things over into. In fact, if you find other investments, perhaps everything that you had has been in real estate and you're living about real estate and you wouldn't want to be in real estate. But for a period of time until you find that really great next deal, which might be 2 years down the road, and that doesn't fit into the short time windows of the 1031, right? With the DST, you can invest in the meantime in 5% treasury bill. You can invest in the meantime into a 11% or a 29% debt fund, right? And I throw out those numbers very specifically because we have some of those available for our clients, right? So you can do some short-term things in the meantime to take advantage of what would otherwise be lazy money and hold it within the trust until that next big opportunity comes along. The other thing that allows you to do is if where you made all your money over your life was in a business, we're talking to several business owners right now, and you now want to diversify into real estate or into something else, the deferred sales trust allows you to do that without chopping up your asset into small little pieces for tax purposes. And those are some of the key points of the deferred sales trust, right?
Yeah.
The power of timing and the ability to diversify your underlying assets into what makes most sense.
Absolutely. And particularly the 1031 exchange right now, we've seen interest rates that have gone to like 6-7%, maybe 5% if you're really well qualified, from about 3.5% to 4%. And cap rates have kind of remained the same. So it's in this influx, right? You used to be able to borrow lower and have a cap rate higher, but now it's flip-flopped. Cap rates are still relatively pretty low and interest rates are higher. And so you're even in a worse situation if you sold at a 3.5% fixed rate debt and now you're having to borrow at 5.5%, 6% or 7% debt. And the cap rate, let's just say at like 4 or 5. And so this is causing people to say, oh my gosh, maybe I shouldn't do a 1031 now. Maybe I should be on the sidelines. Maybe I should wait. But it also leads into what, Pierce, in regards to a new depreciation schedule. Why is that important?
Well, it's huge because, I mean, as you do 1031s, right, your depreciation schedule travels with you. Throw on there your cost seg studies and your accelerated depreciation strategies. And it really kind of like it eats away at it. So as you upgrade, right, you get the benefit a little bit of the new depreciation, but you're carrying that baggage with you. And if you just cut it and you do a deferred sales trust, you're cutting that whole thing. You're severing that tie. And then when you go back and you purchase real estate or you go back into, a position where you can, kind of like accept that depreciation, you get a whole new schedule.
Yeah, exactly. So in a 1031, the old schedule travels, which is not good. So if you own multifamily, it's 27.5 years, you fully depreciate it. If commercial, it's 39 years. If it's a primary home, you don't even have depreciation. If it's stock or crypto, you don't have any depreciation, right? If it's a business, you probably had some, but a lot of businesses, there's not a lot to take there. But the point is, once you convert your equity, your asset sale into a deferred sales trust, at first you're a lender, but then you can partner with the trust and become an owner in an LLC to go purchase, let's say, investment real estate or a business venture. And that particular deal could have a new base. It does have a new basis, and then it could be potentially depreciated. If it's like multifamily, you can accelerate it, or other assets that are depreciable. And that's what we call tax flow. So it's looking at not just cash flow and exiting, it's looking at the ability to be an owner again after you're a lender with the DST and establish a new depreciation schedule. And so that is the power of the deferred sales trust. So not only are we using the law of compounding interest to defer your capital gains tax. But then we're using optimal timing to build wealth when it makes sense for you. We're also paying off debt, typically all the debt at closing, at the close of the asset. So you're debt free, you're in a more of a safe harbor position. And then we're looking at ways, I mean, we could call this, I don't even know what you would call it, Jake or Pierce. You have to think about this. It's like, I guess it'd be tax flow depreciation compounding interest, because especially if you've never even taken or you didn't even have depreciation to take on the asset that you have. It's almost like it's an exponential return, Jake Miller. What could we call that? You know, that imagine, especially if you had either no depreciation or you had an asset that didn't even have depreciation to start with. And now we're basically converting it an ability to get depreciation. What would you think, Jake, we could call that?
I would just call that winning in the market, Brett. It's something super simple in the sense that in this scenario, you're not only winning because of the compound interest, winning because of diversified assets, you're not only winning because you're able to continually put your gross amount of assets to work for you after the shell of some highly appreciated asset, but you're able to take additional tax benefit, or what we call phantom expenses, which is depreciation. We're all familiar with real estate. We're all familiar with depreciation here. This is an additional form of rate of return. And so if we look at the true IRR, what we find here is the savings on what you owe in taxes, the deferral of taxes, and the fact that you have a bigger pie. So instead of, in your example with the penny, instead of reinvesting 72% of 1 cent, you're able to invest 99% of that 1 cent through this transaction, which is incredibly huge. And so you have a rate of return from the asset. You have a rate of return from the depreciation, because that diminishes what you would otherwise owe personally outside of what we do through the joint venture and how we invest with the trust as a silent partner, as well as the power and control over timing, which you can't really put a number to that, Brett, but that often is what opens up opportunities. The power and control over being able to deploy your fund in the timing that makes the most sense. Instead of trying to forcibly, hey, it's a good time to sell, and then forcibly trying to buy at the same time, sometimes that just doesn't work out.
Amazing. I love that. And it spurs some thoughts here. I'm thinking there's like tax flow 1.0, which is defer the capital gains tax, depreciation recapture. Tax flow 2.0, create a new asset, LLC, create a new LLC which purchases an asset which establishes brand new depreciation schedule. It's kind of like Web 1, websites and the web, Web 2.0, Web 3.0, right? And I think Web 3.0 would be using, the things like cost seg to bring it, accelerate it, right, with the DST. So, Pierce,
I would actually change that, because cost seg and all that other stuff, people are doing that today. Okay. I would say that's the 2.0. I would say 3.0, Brett, would be the resetting and gaining of a new depreciation schedule, because nobody else can do that.
Right. The reset and gaining of a new depreciation schedule. There it is. Okay. And maybe it's like a tax flow compound return, or phantom tax flow compound return. The secret to phantom tax flow compound return is tax flow 1.0, 2.0, and 3.0. And
well, Brett, that's why you're the author of a book and all these other things, because you have a magical way of phrasing stuff.
Okay, cool. Pierce, are you feeling that? What are you thinking?
Yeah, I think it's a good start.
Okay.
I think it's a good start.
Right. You're thinking about that, okay?
We'll refine it.
Good. All right. For this part of the master class. That being said, let's dive into the deal stories or escrows or live deals, or, and then we'll go into like questions from everyone else. And we do welcome Edmond, Camelia, Christy, looks like Lou, Maria, Micah. By the way, Micah, hello. I think it'd be good to hear from Micah. Micah, it's been a few weeks, at least since I've been on. I was gone last week traveling. Michael, are you there?
I think she took a She took a call from a client trying to get on this call.
Okay, perfect. Sounds good. We'll see you in a minute. Okay, so which deal should we go over?
So Brett, I have one.
Okay.
I think we should talk about our good doctor, and
Yeah.
not the entire deal, just the piece that happened this week.
Okay.
And what do I mean by that? He's receiving installments for a partial purchase of the shares of her medical clinic, of her medical practice.
Mhm.
Okay. So she's getting bought out by a larger conglomerate. She's staying on. She's getting a partial conversion of some of her shares into the shares of the larger company. And she had a choice to convert part of this next installment, which was $1 million. You have the choice to convert part or all of that into the larger company shares or take it as dollars. Now, this is the magical thing about the deferred sales trust. It can receive either of those options. And so it allowed her, outside of tax ramifications, to truly, in an unbiased way, decide, am I going to make more money with my next installment of $1 million? Am I going to make more money converting that into shares that'll land inside of my shares of the parent company, the conglomerate? Am I going to make more money with those shares in my DST, or finding my own investment? And until about a couple of days ago, 2 days ago, she was going to do 50-50. She's going to do 500,000 shares and then 500,000 into some of these other real estate investments and some of these other business investments that she has access to. And then just recently, Brett, and I'm pretty sure that you were involved there in the email thread, that she decided to take actually all $1 million and invest it her own way, where she felt that she had more control and she'd be able to, for her and her family and her household, have a higher rate of return.
Amazing, right? Flexible and multiple ways to defer the tax. The DST comes alongside to help with that. Yeah, it's a nice deal. It's a great deal. And it's a fun deal to see it all come together. So yes, excellent. Pierce, any thoughts on that?
We recently did an interview with a fund that speaks a lot to doctors. So that's a good story to share with that group.
Yeah, if you want, we can actually put a few more details down and use it as a case study.
Yeah,
Yeah,
that would be good.
great. Yep. Very good. Very good. What other ones could we share? I think might be helpful. Trying to look at the list here. So, So, in the meantime, Pierce, what remind everybody, what does the DST work for, right? What kind of assets does this work for?
Yeah, so Deferred Sales Trust works for any highly appreciated asset. It could be a stock, or it could be a business. It could be real estate, commercial, or primary home. It could be crypto. It could be racehorse. Where are we at with the racehorse thing?
Never happened yet, at least not for me or Jake yet. I should probably follow up with them. It's been a while.
There was a deal temporarily on the table. I believe it was a $16 million deal. But, you know,
Freaking expensive horse, man.
People have to get a little bit closer to the finish line, so to speak, on the purchase. Oh, Brett, there's a deal coming to the table right now. There are several owners involved. It's an $8.4 million business sale.
Mm-hmm.
And their tax advisor is bringing this deal to us this week. They plan to close in 1 month. And they're wanting to see how this would be beneficial to them based on the interests of several different owners involved. There are 2 that are the majority shareholder, but there are like 7 owners altogether. So maybe with this coming to the table next week, tell the audience that we have here today, what are some of the first questions or comments that we make to individuals who are considering the DST, the Deferred Sales Trust, for the first time? How do we qualify a candidate, Brett? And then what are some of the key points that we ensure that they need to know so that they can evaluate whether this is a good fit?
Yeah. So first of all, let's start with the timing. Timing is super important, right? and the entity structure, just kind of the stats, like entity structure, timing of the sale, debt on the property or debt on the business in the scenario, adjusted basis in the business, what do they want to do with the money, right? Like, what's the purpose for selling? What's the purpose for their wealth plan? What do they envision their next step of the journey is? To be an entrepreneur, to be retired, be passive or active. The neat part of the deferred sales trust is each partner can go their separate way. We want to know if it's an S Corp, C Corp, LLC. And we want to start to work with them and their CPA to find out, do they have any carry forward loss? If they have some carry forward loss, they might be able to offset their tax. I was on a call with a potential client on that today. So, and they say, oh, I might have some carry forward loss. I'm like, well, sweet. If you do, then you probably don't need us, right? If it's big enough. So we want to just honestly, in a lot of ways, just qualify if they actually want to spend all of this money on their personal use, like their primary home, or on like buying boats and doing stuff that's just personal consumption, that's always taxable. So you just want to qualify that A, they do want to invest into something else. B, they don't need all the money up front to spend on personal stuff. C, we have enough time to put the structure and the details together into the contract. Those would be some of the initial ones. Pierce, you want to add anything else to that?
Do you want to talk about the minimums?
Yeah, go ahead.
So just to qualify for, something, if you're thinking about this, the $1 million net proceeds, $1 million gain is kind of like the minimum that.
Is that per person, per transaction? Well, how would that work on this $8 million deal, Pierce?
Yeah, so that works great for this $8 million deal because it's basically per transaction. Or if you have a couple transactions that you can put the total net proceeds into $1 million.
Two, right? Two at 500 each, not really like
two, 500
two. Yeah.
When you say a couple, I think something that we want to kind of avoid is the guy who has 100 single family homes that are worth 150 grand a piece, and their taxes, $7 grand on each one, right?
Yeah, the good rule of thumb is if you have two at 500 each, you can combine it into one DST, basically at $1 million. But when you start getting, and now let's say imagine you have one at 700 and one at 300, that's good. That's fine. You basically want the two to have $1 million gain, $1 million net proceeds. And then, on the $8 million deal, you have that's a percentage of ownership. You might say, what percent of ownership are you? And if someone's only a 1% owner of it, that's small, that you just pay their tax. But the other two partners they split it 50-50, then we would work with them. So is each partner's gain $1 million at least? And is their net proceeds at least $1 million? That's net of closing costs and debt. Then yes, you qualify to use the DST.
Well, and it's not always so much about qualifications other than what makes most sense, right? Mm-hmm. Is there enough tax paying? Right now we're talking about qualifications and minimums, and really all of those are arbitrary things that we throw out there to help educate people. It's not hard and fast. It's, hey, if it's $1 million, then you're already looking at a minimum of $200,000 in taxes, plus another 3.8% in Medicare taxes, plus any state income taxes that they're going to charge on top of all of that. And that becomes a home run or a no-brainer that, hey, this is a good decision for you, so that you don't have to cut down your asset into small little pieces and pay all these government entities, that you are allowed to reinvest for investment purposes the bulk proceeds of the transaction.
That's a great point. Yeah. And so it's a great point. Yeah. Because you're not disqualified if you don't have that. It's not like it's an IRS rule or an IRA rule, right? Where you're disqualified if you're doing certain things different ways. It's more, doesn't make financial sense. And so it also depends on what state you're in. If you're in California and you have an $800,000 gain or two $400,000 gains, hey, you're already or New York or New Jersey, you're already, there's certain states like Nevada, Texas, Florida, right? There's no state income tax. So you don't have that additional state income tax on top of the capital gains tax. So it's federal, it's 20 and Obamacare 3.8. So Jake's exactly right. So it is a case by case basis, but the general rule of thumb, no matter what state you're in, no matter what you're selling, if you have $1 million gain, $1 million net proceeds, we found that to be typically a home run, as long as you can delay receiving the principal. In other words, you can just live off the interest payments which, but so come talk with us. We're happy to talk. We work on a no cost, no obligation basis. And you can find out, you can go to capitalgainstaxsolutions.com to connect with me. You can also go to strategictaxsolutions.com to connect with Jake Miller. Pierce, where can people find you?
KingdomLuxuryRealty.com.
Yeah.
And you can also find me at Living in Newport Beach YouTube channel.
Fantastic. So we're gonna open it up for everyone now. We've given probably a lot of content for everyone to hear here. Hopefully you found it valuable and a lot of meat on the bone there. So does Christy, Camelia, Adman, Lou, Micah, does anyone have any thoughts, questions to ask Pierce, Jake, or myself? You can go ahead and put in the chat. You can also unmute yourself and say hello. And it could be about
maybe just a few things, Brad. It might be nice to talk a little bit about your commercial realtor experience. I say that because with Christy, I mean, you can see from her profile image that she's with Keller Williams. She and I had a nice conversation before this call about some of her clients that could really utilize this strategy. Clients that perhaps a 1031 is not a good fit for, and clients that have higher dollar transactions. By the way, she's in the near Dallas, Texas area. And so rather nice lady and very, very insightful questions.
Excellent. Yeah. And I'm going to couple that with, I actually got a message from Adman regarding a scenario where the DST utilizes the 1031 at all. In other words, I think he's asking, is there a scenario where you could do a little bit of both, like a bifractor 1031 exchange? And the answer is yes, Adman, right? You can. In fact, we do, depending on what we're trying to solve for. There's multiple deals where we're doing partial Delaware 1031 exchanges, partial traditional 1031 exchanges, and partial deferred sales trust. Okay. And it just depends on what their debt over basis issue might be. If they have debt over basis, it's one thing that deferred sales trust cannot defer is debt over basis. On a 1031 exchange, we want to exchange the debt from the property and the asset that she sold into another asset to replace that debt. And that allows us to do the rest of it into the deferred sales trust. So in fact, Jake Miller and I just closed a deal like that. It's actually more common, I think, today, because a lot of people did cash out refis over time. I was on a call with a gentleman today, exact scenario. He's selling about a $4 million asset and he has about 2.6 million of debt. His basis is basically zero. And he goes, look, I don't want a 1031. It's the last thing I want to do. I want my capital liquid and diversified. But he goes, but I don't know how to get out because guess what? He's in Taxifornia. So that's faced with we estimate to be about $950 to $1 million of tax, of ordinary income tax alone, because his debt over basis is so high. And so each situation is a little bit different. But the answer is yes. Jake, you want to add any of that with multiple ways to exit?
You know, Brett, I oftentimes tell people that it requires comprehensive planning when you are experiencing some of the largest transactions of your life. That you should utilize or view the deferred sales trust as the keystone in the arch. It is the keystone or the principal strategy that has the biggest effect and provides the most flexibility, but that doesn't mean that we don't interject and add to the deferred sales trust several other strategies. When it makes sense, when it is necessary, at 1031 into a Delaware Secretary Trust Fund, or any number of other tax saving or winning in the market strategies that we can implement to make your overall outcome even better.
Well said. Absolutely. So good question, Adman. Now, Christy, if you're there, I would love to say hello to you, Christy. Always like new guests on our mastermind. So if you're there and you want to unmute yourself and say hello, and if you want to do on video, even better, you can do that. Otherwise, you can just check us out like you are now, which is cool. Hopefully, maybe you're in a spot where it's really busy. But we do have Micah here. Micah, how are we doing? You're back.
I am back. How are you?
Doing well. What thoughts or questions or comments do you have from everything we've been talking about today? Any thoughts on like the tax flow, compound interest thing we talked about in the beginning, or any of the above?
Well, I personally just like the flexibility that you get so that you're not stuck in paying or doing a 1031 exchange when it might not make sense for you to purchase another asset. So it's kind of just a powerful tool in your tool belt.
Absolutely. Yeah. It's just getting a chance to get that flexibility and that freedom from having to own and manage and do all of the things. I was on a podcast this week and they asked me for the transformational story, and it brought me up to the reminder of Warren's story about the two twins, right? And trading the toilets, trash, and liability for more time with his twin daughters. They were 10 years old. And he was driving 4.5 hours. You remember that? Into Placerville to have to manage the property. And part of his heart was like, I want to take care of my tenants, and I put a lot into it. But the other part was like, it's taking me away from my family. And like, you only have so many years when the kids are young. And so for him, it was like, that was the transformation. That was the freedom. And he is so happy. He's so relaxed now. I talked to him. He's just like, you guys remember, it was about 2 months ago he got on here and we were talking. He's just like, it's so nice not to have to think about that property anymore. Like sometimes you don't realize what a burden something is until it's gone, right? And then all of a sudden you're like, whoa, one day you look up and it's been a couple of weeks since that thing's gone. You're like, my shoulders just feel lighter, right? Is that what you mean by that, Micah? Or maybe I'm on a whole other spot here.
No, that's definitely part of it, because I mean, you really don't have to do that window of when you need to purchase that next property, or when you have to do, and just the flexibility. It's an amazing product. It really, really is.
And Micah, what do you think some of the biggest objections might be for someone though, like who's learning about this for the first time? They would say, who is Jake Miller? Who's Brett Swarts? Who is Micah? How does that all work together too?
That's true. I mean, yeah, there's a lot more moving pieces. There's, you have a trustee, you have a financial advisor, you have attorneys. I mean, that's kind of going to go hand in hand with just how it needs to be structured. But the nice thing is that you have Brett along the way to kind of help hold your hand and make sure that it all kind of goes from point A to point B and really paint that picture for you. But maybe I would say some of the bigger objections for a person that's finally hearing this for the first time would be becoming a note holder instead of being the asset holder of the property or of the deal.
So smart. And Jake Miller, how would you answer that? Hey, I'm no longer an asset holder. Like, I'm giving up ownership that I've always run my business, my real estate, whatever, right? What would you say, Jake, to that about becoming a note holder?
So this comes in line with some of the education that we provide, which is important, which is also why it's important that we get in front of a transaction, not days before, but preferably 30, 60 days or enough time so that people have the opportunity to get educated by us, then double check us with any resources they might have to find and confirm that what we're portraying is true and real. Then they can feel confident about what we're presenting. In this circumstance, it's really important that they know and understand rights to an asset, whether it's ownership rights or lendership rights. And I always like to compare this to a home because everybody is familiar with mortgages. Everybody's familiar with debt on a home. And a homeowner possibly could lose rights to their home to a home lender that has superior rights to that home. Should that homeowner forego payment, that home lender can step in and take the property. And so similarly with the trust, you're going to switch from ownership of an asset to lendership of an asset. That asset moves into the trust. The trust now owns the asset, but you are in a superior position by being a note holder. The way the contract and everything else is written, you have lendership rights or creditor rights and have the ability to take control of the asset of the trust, to liquidate or to remove a trustee. So at the end of the day, we have a trustee that allows for the deferral of an otherwise taxable transaction, which is incredibly important. It is integral that if the IRS were to ever look at this transaction, that they see somebody between you and the transaction so that you're not taking constructive receipt. As long as that is there, the trustee works hand in hand with you. Oftentimes there's a dual signature process. The creditor, the new creditor, which once was the owner, the new creditor has to sign off on every investment or money movement decision, which is imperative to know and understand that people are still in control. They now just changed hats. They swapped hats with the trustee. Trustee now is over the trust, and the trust asset has a fiduciary responsibility to do what's in the best interest of the trust asset and those beneficiaries of the trust. At the same time, the trustee can't do anything without the approval of the creditor, the lender, which is where the asset originally came from.
Amazing. That was genius. That was brilliant. That was so succinct. So everyone give a round of applause for D. Jake Miller. By the way, he is coming out in the book. He'll be in the book right here. Building a capital gains tax exit plan. I got a couple of chapters too, but Jake's chapter is amazing here. In fact, you know what? Just for everyone, so you can know, why don't I read a few words from D. Jake Miller? In fact, the Jake Miller, which is amazing. It's called How the Deferred Sales Trust is a Game Changer. How's a game changer? It's on page 87 for those who maybe have picked up the book on Amazon or your Kindle. It might be a little bit different on the Kindle Fire. And what's really great about Jake is he has an amazing mind, and he actually was a part of over I would say consulting and working with over 10,000 accountants, right, or accounting firms, owners from across the country to help vet and look through different types of tax strategies for their clients. He'd be the person that they would bubble up some of the ideas. He'd be the person to research it and to look at it on a deep level. And so he says, I coached the top 400 of 10,000 members who paid to receive the most help. We assisted them with financial strategies that help mitigate taxes or decrease overall tax burden, while at the same time building outside assets. While doing that, I would receive strategies from CPAs across the country. Sometimes they were good, sometimes they were bad, but I'd have to vet them. I'd have to go do the due diligence and say, is this something for the whole group? Is this something that we could warn people about in case it's not, up to par for the standards of track record and IRS audits and all of those things? And he goes, sometimes you go to these dinner seminars with some attorney and it ends up being some kind of kooky thing, or maybe it's just so new that the IRS hasn't tested it yet, or they haven't done it thousands of times. And you can really give advice on something if it hasn't, you can't really give advice on something if it hasn't really been through the filter. It makes you wonder, is it a safe thing? That was my job, not only to answer the questions, but to do the due diligence on the various strategies we could come across. So that was the first reading officially out of this book on a live stream. So Jake Miller, let's give him a round of applause for that wisdom he just shared with us and the wisdom in the book. Jake, any thoughts on that?
Well, you make me blush, Brad. I didn't know that you were going to read that out loud, but it's important and it's imperative that here in this public format that we have, it's recorded, it can be replayed, it's going to be out there on the internet forever, for all time, that everything that we're providing people is sound and good. Like it's correct. It's not our thoughts. It's not our opinions. It's what we found to be factual, and it's what really can help everybody. Now, of course, everyone's situation is a little bit different, and we definitely should, with this strategy, customize our advice and our support to everyone involved. But again, something incredibly important based on my comments that you just read out of the book, some facts about the Deferred Sales Trust. The Deferred Sales Trust, there's been thousands of them. There are billions of dollars deferred that people did not have to pay taxes on because they used the Deferred Sales Trust. There have been audits and reviews, an IRS review or an IRS audit in regards to the Deferred Sales Trust, which is important. That is a good thing. That provides a history. And second important to that is the outcome of the review and the audit.
The most important part, right? Yeah.
Which currently, the Deferred Sales Trust has a 100% track record. It's batting 1,000. Out of all of the 22 reviews or audits over the last 26 years, there have been 0 findings, which means the IRS found nothing wrong. And there have been 0 changes. Sometimes even when the IRS says it's not wrong, we would recommend or suggest or we demand a change. They did not do that with the Deferred Sales Trust at any time. And that is amazing, Brett. Out of over 423 strategies that we implemented with this CPA firm owner association, there were only 2 with 100% track record, and the Deferred Sales Trust is one of those 2.
Amazing. Yes. Jake, that was fantastic. Pierce, any thoughts before we wrap this up today on anything that was just said?
I just think that sometimes people don't really grasp how awesome it is that there's been so much. It's been tested through the fire so many times. You know, people are like, "Oh, is it like too good to be true? Is it even legal?" And I mean, like when I tell people, yeah, it's had like 23 like audits and reviews, like all of them, no changes, no finding, 2 like deep audits where they like literally like whiteboarded everything out. I was like, and I say like no changes, no findings. I kind of like say it, and maybe I don't pause long enough for them to like understand. Like it's like a home inspector going into a house and saying like, "Oh, your house is perfect." After 23 years, it just doesn't happen. 27 years. I keep saying 23, man. Has it been that long?
You're getting old, Pierce, with those
Dude, I was just thinking, man.
Time starts to just move.
Dang, 27 years. Wow.
Yep.
Yeah, it's incredible. To have something that long with the track record. I mean, I guarantee you the 1031 doesn't have that. People have failed their 1031s for sure. Way too many times.
That's a good point. People have failed it, right? The 1031 hasn't failed, but people have failed it. That's a good point. That's a good point. It's a great point. Yeah, I wonder how many DSTs have actually people did. Well, we just, if it passed certain things, we don't do it. So that's part of why we have a perfect track record, because we don't step over the lines. That being said, I want to do a little tease for next week, by the way. So I was at this big conference, right? And it was really cool. And people are asking lots of questions. And then one in particular had said, "Hey, I talked to other CPAs about the DST, and these are some of the challenges. And in fact, I want to cover this next week as a thing." He says this. I had a conversation with an accountant group, and they had some knowledge of the DST. Okay, I'm kind of paraphrasing this. I asked him his thoughts on using the DST because I was curious to see what he had to say, and I was a little surprised to say the least. And I'm paraphrasing now, but here are some of the things he brought up, the gist of the conversation. The CPA group, or this person who works with CPAs, said, "Pay the tax now. Pay the tax now, as capital gains tax will never be low again. Ever be this low again." And he goes, "I've spoken with 3 accountants, and they all say the same thing to me." So next week we're going to be covering that. Now we covered a little bit, some pre-education right now with the law of compounding interest and what we talked about. So keep that in mind. But we're going to address this exact thing and perhaps why your CPA or our CPA might be saying this. Number 2, he says, for the DST, according to this group who works with the accountant, or this accountant group, the initial setup fees are too high, too much. He says much of what is done by the lawyers is boilerplate, and it's just the names and the amounts change. Like, it's just so simple. It's just like setting up like a living trust. It just change. It's simple. Like, they charge too much for that, right? So in other words, the DST is too expensive. We're going to cover that next week. Then he says the note is not secured, right? It's a piece of paper, right? What's the collateral? How do we know it's secured? How do we know it's protected? We're going to cover that next week. He also says, what if the trustee steals the money or is incapacitated in some way? We're going to cover that next week. What do we do in case Brett gets hit by the bus, right? And then at the very end, he says, there are other ways to lower the taxes. Call me, okay? So next week, those are all of the interest generators for everyone to come back. We're going to cover one by one by one. We're going to be going down these, and hopefully we'll do a great job to communicate the value, the purpose of using the DST and what that means for you should you exit. Now, we bring these things up so that hopefully you can take action with all of what you're hearing right now. If, in fact, we're going to encourage you, if you have a live deal that has $1 million net proceeds, $1 million gain, we want to encourage you to start right now by going to capitalgainstaxsolutions.com to connect with myself and one of my team members as well. Make sure you said you saw this webinar or this masterclass, not a webinar, masterclass online. You can also go directly to strategictaxsolutions.com to get with Jake Millard. Start there, which is great as well. You can also go to Kingdom Luxury Realty and connect with Pierce York. Pierce is a commercial and luxury real estate agent in Newport Beach. And all of us are happy to help you just take some action. And if you could, check out this book. We just came out, Building a Capital Gains Tax Exit Plan. Amazon, get a copy. In fact, it's technically like Kindle, like right now, but like next week it's releasing. So if you're actually seeing this as of March the 31st, 2023, it may not even be on Amazon yet. It's that hot off the press, but Kindle is there, and it really is happening, people. All right. That being said, I want to appreciate everyone. Thank everybody. I want to say a wave, goodbye, thank you, and we'll talk to you. Be free, everybody, and we'll talk to you next week. Okay.
Bye now.
See you next week, everyone. Thank you. Bye-bye.